if you're leaving a company, or indeed if you've left employment, a lot of people have changed jobs over the last 2 to 5 years. There are options that are presented, and some people leave their pension schemes in previous employments. I'm personally not a big fan of doing that. You lose visibility of the scheme, and it's not necessary. There is the option of transferring it to your new company pension, but there's also the option of transferring it into what they call a pension bond, or there's another term used which is called a PRSA. Now, without getting into terminology today, I feel that this is certainly an option to consider on the basis of being able to draw your pension entitlement down early, particularly from the age of 50 years onwards, which may enable you to reach other financial objectives that you have, for example, buying a holiday home or becoming mortgage free. But also that if you've been working in the company for, employed in the pension scheme for 2 years or less, that you may be entitled to take back your contributions less a 20% tax rate, which effectively becomes a very favorable savings scheme, given that you got tax relief at 40%.
So Nick, for somebody, let's say that's been made redundant, should they waive their right to tax-free cash or preserve it?
So basically, just to explain the question, what happens is that if you are made redundant, you're given a severance in many cases. And one of the options that you have is to just choose whether you take a higher sum now and forego the benefit of the tax-free cash when you draw your pension scheme. And people would have thought that in most cases that would be sensible. Now, interestingly, because of this PRSA that I mentioned earlier, and again, not to get into too much terminology today, you can actually waive your right to the tax-free cash, get the higher benefit now, and by moving your pension into that PRSA, you are legally entitled, and Revenue are absolutely fine with this, to draw down your tax-free cash as well. So what I'm really saying is that if I was in that position, I wouldn't, I would waive my tax-free cash. I would take the higher benefit, but I'd also be looking for my tax-free cash when I draw my pension down. You can basically get it all.
So for anybody maybe on the call who has maybe moved jobs already, or maybe moving in time, like you've mentioned about just the options with moving pensions or leaving them with your current employer, and you've said you're kind of unfavorable to leaving them with the current employer. Can you maybe give just a little bit of background around that and why that is the case?
Yeah, the thing is, we're talking now about kind of phased retirement. When I talk about retirement, I'm talking more about financial independence, like not having to work. People may choose to. I'm 49 years of age. I may work, and I'm going to show you briefly in a moment about what my financial plan looks like. But the reason I don't like leaving pensions from, in previous employments is that, as I said earlier, you lose visibility, but not only that, you lose the right to be able to draw them down at different stages. So again, it might help you in terms of this phased retirement where you might want to work less hours, maybe part-time. You may want to change careers, go into a different industry. And by being able to access these different pension pots at different stages of your life, I think is really powerful, and it's really worth exploring for the benefit of the fact that these pensions that you move, as long as you make sure that they're in a good provider at a low fee, which is really important, and I'm really keen to make sure that people pay the lowest fees possible, that it can actually work out more favorably.
Okay, I have one or two more questions, Nick, actually, if that's okay.
Yeah, please.
Before you move on, can you just clarify exactly what you mean in point 4 on this slide, please?
So point 4 is saying that if you've been, you could have been employed by the company for more than 2 years, but if you've been a member of the pension scheme for less than 2 years, most companies automatically will take back their contribution, and that you are forced to take back your contributions less 20% tax. So sometimes this is a forced situation rather than chosen. But in some instances, it might actually serve you, as I said, getting the money back, less 20% tax relief. Now, it can vary because some companies will allow you to keep their contribution, the company's contribution, if you retain the monies in a pension scheme. But as I said, that's an option that we can get. And for anyone that does leave a company or has left a company over the last number of years, we get the leaving service options form, as it's called, which states those 4 options, and we help you understand them, and we basically hold your hand in making the right decision for you.